Most people have a completely wrong idea of how hedge funds test investment ideas. The common perception is that someone looks at a chart, spots a pattern, and puts on a trade and just makes money, right? But the reality is much closer to a science lab than a trading desk. Professional investors spend far more time trying to disprove ideas than prove them. They're constantly asking one question: is this edge actually real, or did I just get lucky? And that's what I want to show you in this video. Not how to pick stocks, not how to predict markets, but the actual process that serious investors use to determine whether an idea deserves real capital. So the first problem is something called overfitting. And honestly, this is where most retail traders fail before they even start. So us humans, right? We are pattern recognition machines. We see patterns everywhere in life, right? It could be in clouds, we see them in sports, and we definitely see them in charts, right? And the problem is that seeing a pattern doesn't mean the pattern is real. So let's say I take, let's say I look at 10 years of market data, right? And maybe I notice that every time volatility spikes on a Tuesday or a Wednesday and volume is above average, the market tends to rally over the next few days. That sounds interesting, right? But here's the problem. So this is the data I already saw. And this is the future, right? And those are not the same thing, okay? Key thing, those are not the same thing. Just because a rule explained the past doesn't mean it predicts the future, right? In fact, if you keep tweaking a strategy long enough, eventually you'll find something that looks incredible historically. The catch, though, is that it may be nothing more than just random noise, right? And so this is why backtests can be dangerous, right? Not because backtesting is bad necessarily, but because it's incredibly easy to fool yourself, right? And so what I want to show you now is the scientific method, right, for markets. So professional firms deal with this problem that we have by borrowing something from science, right? The scientific method, right? And this has some steps to it, per se. So first and foremost, everything starts with a hypothesis, right? Not a chart, not a signal, but a reason, right? Why should this work? That's the key question. Why should this work? What's the mechanism? What behavior are we exploiting, right? And if you can't explain why something should work, that's already a warning sign that you should have in your, light bulb in your head, right? And then next comes defining the signal, right? And this right here is very critical. The rules have to be written before the test, not after, right? Otherwise, you're just fitting your strategy to whatever happened historically. And I want you to remember that. So I will write it out over here. Before testing, right? Not after, but before. Okay? And so you want objective rules. You don't want rules that another person, you want rules that another person could reproduce exactly as you did, right? So you want them to be very objective, and you do this before you start testing, okay? Number 3 of this scientific method would be to backtest, right? Now you run your backtest. You apply the rules to your historical data, And this is where you get your first look at performance, right? So your returns, your win rate, your drawdowns, your risk-adjusted metrics, etc., right? But what you have to keep in mind is that this is still not enough, right? And so we move on to our fourth step, which is statistical validation, right? So the next question would be, was this result actually meaningful, right? Or could it have happened by chance, randomly? And a lot of strategies look amazing until you realize that the sample size was tiny, or the effect wasn't statistically significant, or the edge disappeared when tested another way, right? And so we have to make sure that statistical validation happens, okay? And then fifth, we have to look at out of sample tests, right? And so this might be one of the most important steps in the entire process, okay? The out of sample test, okay? And so I want you to see here, this is data that you're like allowed to look at, right? This is your training data. And this on this side would be you're not allowed to touch it, right? You're not allowed to look at it. This would be out of sample, okay? And the reason why we do this is because once you've looked at data consciously or unconsciously, you've already learned from it, right? And that can bias your results. So professionals reserve data they've never seen before, and then they test their strategy right there, right? So that it hasn't seen what's already been tested on before, and then we ask the question, did it survive, right? And we check if it survives, and now if it did is when you get interested, right? If it collapses, the edge probably wasn't real, right? And so next I would like to talk about the costs, right? This is also very important. Hedge funds do look at this quite often, unlike most retail that never really considers this, right? Now, let's assume your strategy survived everything, right? There's still another problem that we have, which would be just reality, right? And so most beginners, they just calculate their gross returns, right? Their theoretical returns, their perfect returns. But in reality, real trading isn't free, right? And so we have all of these costs. We have there's spread, there's commissions, there's slippage, there's market impact, execution delays, you name it, right? There's many different costs that we have to take into account that most retail doesn't. But you have to realize that each and every one of these affects and eats into your performance, right? Sometimes a strategy that looked fantastic on paper becomes completely untradeable once costs are included, right? And that's why what looks good is not the same thing as what actually survives, right? And hedge funds understand this, and that's why they're always looking at costs. You always have to look at these different costs. So this is probably the hardest lesson to accept realistically, but what I need you to understand is that most ideas fail, right? And that's exactly how it's supposed to work, okay? If you're testing properly, failure is normal. In fact, I'd be suspicious if every idea worked, right? Because markets are very competitive. And if profitable edges were, easy to find, then everyone would just exploit them, right? And so what the goal isn't to make every test successful, right? The goal is to eliminate bad ideas quickly and rigorously. If you could take something away from this video, I would like you to remember this. Okay. This one quote: "A failed test done rigorously tells you something real. A successful test done sloppily tells you nothing." Right? And that's one of the most important lessons I've personally learned as I've went down my journey through this whole process, right? And this is what hedge funds understand, that, like, I know I've said this many times, but this is what hedge funds understand that retail doesn't, right? Most ideas fail. Your job isn't to find what succeeds, but your job is to basically find what fails and cut those losses out, right? That's your job. So, what does this mean if you're not running $1 billion hedge fund, right? There's three things, in my opinion, right? Number one, I would encourage you to be skeptical, right? Be skeptical of strategies that supposedly always work, okay? Especially if they don't show out of sample testing. We've talked about this, but out of sample is very, very critical, right? Very crucial. Number two, I would like you to understand that professionals fail constantly, right? Most research doesn't produce an edge, and that's normal, okay? And lastly, I would like you to, I covered that, didn't I? Lastly, I would like you to focus on process more than outcomes, okay? A good process can lose money. A bad process can make money temporarily. The outcome of one trade doesn't tell you much. The quality of the process tells you almost everything, okay? The people who perform the best in markets aren't necessarily the smartest, right? They're usually the most disciplined, the ones willing to test ideas honestly and accept failure, right? And follow evidence where it leads, okay? Because you have to understand that markets are hard, and the people who do best are the ones who take that seriously and who truly understand that and internally accept that. That's all I have for today. I appreciate you guys for tuning in. I hope you guys learned something today. If you took anything away from this, that'd be very nice. That is my goal. So hopefully you have a little insight on what hedge funds really think as they're going through their process of doing their job, right? But yeah, thank you for watching, and see you in another video.